Hey everyone, how's it going? So today I thought I would show you how to manage a credit spread using a butterfly spread. If you're not familiar, a butterfly spread is basically just a credit spread and a debit spread combined. So a credit spread would be, just selling the 300 here and buying the 290 put. And this would be a put credit spread. This is the QQQ. If we wanted to do a butterfly, that would be basically we buy a 300, we sell two of the 290s, and then buy a 280. And this is basically, I guess, what would be considered in just a normal butterfly. Your wings are basically 10 points apart. Basically what you have here is a 300 290 debit spread combined with a 290 280 credit spread. And the most you can lose on this trade is roughly $1.06 at the time with these strikes. And if we want to look at this at the Analyze tab, it basically looks kind of like this. So, what we're going to assume here, we're just going to assume that maybe sometime, I want to see maybe like 425 here. It looks like the QQQ closed around 330, 328 a share. And we're just going to assume that we went out, say 50 days, and we sold a 10-point wide credit spread, and we're going to do it right around, say, the 300 mark. And if we go to the Analyze tab and go to Think Back, I've already pulled this up just because I wanted to get an accurate price to see what this spread was trading for. So on 425, QQQ closed at 329. If you entered the 300 290 put credit spread, you would have received $1.75 credit. So that's $175. So let's go ahead and add that. So with only 16 days left, we can actually see what that would be worth right now. So it's basically worth about $258 now. So we're at a loss, and we are getting close to basically our short strike here. So, if we decide to close this out right now, we would close it for a loss. So one thing that we can do, and let's say that we want to try to push this down a little bit to give us some breathing room below 300. Something that we can do is we can buy, let me go ahead and add this to the Analyze tab. And we're also going to say we sold it for $1.75. Okay, so now it shows us this is our profit and loss. So now it's basically saying, we're down roughly about $93 today on this trade if we had entered it. So something that we can do, we can enter since this is a 10-point wide credit spread, we can basically just do a 10-point wide butterfly, and we can place our strikes close to these strikes here. And what I mean by that is, since we're short this 300, what we can actually do is we can buy the 301. Now we're going to sell two of the 291s and then buy the 381. And this is going to cost us roughly $1.10. So that is going to take up about half of the credit that we had originally received on this trade. But this will be what the new risk profile will look like before the butterfly. So this is just the butterfly. Before the butterfly, we can see that our break even is roughly at, it looks like 298 right there. And like I say, we had 175 was the max that we could make on that. Once we add the butterfly in, it puts our break even down to 290 now. And it gives us kind of this little profit tent right here as well. So we could actually make about 164 between, it looks like 290, 299, I think that is, all the way down to about 292. So it has increased what we could earn right here. But if the stock turns around and goes back up, instead of collecting this $1.75, now we're only going to collect roughly about 64 cents. It showed it right there. So, it has lowered the maximum return that we can get, but it also has pushed farther down our break-even point. And because we basically used, I guess, an equal leg length butterfly here, since it's 10-point wide on the debit side and the credit side, there's really, the only risk on this is this $1.11. So we can see that actually our risk in this trade really hasn't changed any. We still have $936 of risk here with the butterfly on. With the butterfly off, it's $825. So, the risk did change a little bit, but it's not a considerable amount. Now, something else that you can do, if you actually want to not pay as much for this butterfly, what you can do is you can basically, I guess, what they call skipping a strike. So if we do the 301, 291, and then instead of doing the 281, let's go to the 271. So now what we have is we have basically a 10-point wide spread on the 301 to 291, and then the 291 to the 71 is a 20-point spread on the credit side. So this is going to let us enter this much cheaper for about 28 cents, but it's going to increase the amount of risk that we have now in this trade. If we analyze that, so now we have our credit spread, and this is the new butterfly. We can see that our risk now has went all the way to roughly 1854. So it's practically just double the risk because we have a considerable amount of tail risk right here. And you can actually keep buying this lower put down here, this 270 or 271 we bought earlier. We could actually go even farther out of the money and eventually get a credit here if we wanted to, but it's going to keep adding, I guess, this tail risk on the bottom. So, if we go to the 265, now we can enter this trade for 3 cents. We can see that our break even is still down around 289. And if we go to the 260, we can probably actually enter this for credit. Yeah, so 11-cent credit. But now we have our tail risk comes all the way down to roughly $2,900. So that is something to think about if you want to try to do that. This actually will work better the more days to expiration that you have. So, right now we're at 16 days. The closer we get to expiration, basically the more money it's going to cost to add in this butterfly. So whenever you're trying to, I guess, structure this trade, it's going to be up to you to decide, do you want to try and do this for a debit or credit? If you do it for a debit, you basically, you're not really going to increase your risk anymore. All you're doing is just pushing down the break-even point lower at the expense of giving up some of the credit that you had initially received. If you try to, get a credit to roll this down, getting a credit is going to basically keep your same potential profit that you could have gotten at the expense of increasing, I guess, maybe what you would call tail risk. You have a lot more risk down here. In case the market really drops, you could be in trouble there. Another thing to think about here is this works better, I guess, the farther away you are from your short strike. If we try to do this, let's say in a couple of days, the QQQ comes down to 300. Trying to enter this butterfly is going to be more expensive to do. So the farther away that the current stock price is from our strike price, the easier it's going to be to do this. Another thing is normally once you start getting closer to expiration and your strikes are close to one another, it's going to get more expensive as well. So it's better to be more proactive to do this if you think you're going to do it. And you may decide it's not worth doing at all for you. It's not going to work in all instances, but if we had this 300, 290 here, we can see that in the last couple of weeks, we were down around this 290 range, and that may be just enough to get us this final 16, 17 days in this trade to maybe keep some of this profit. But it's just something you'll have to decide for yourself. But anyway, this is a strategy that I have used in the past. Sometimes it works, sometimes it does not, but it's always nice to just have kind of different tools in your toolbox to use. Anyway, thanks for watching. Hopefully this was helpful, and have a great day. Bye.